Joining us now to talk more about the markets is Allianz Chief Economic Advisor Mohamed El-Erian. Mohamed, nice to see you on this Friday.
Good morning. Thanks for having me.
Are we too frothy?
Look, we are riding a massive wave of liquidity. It has worked extremely well, and I don't see why you would want to go against these very strong short-term momentum. Having said that, what's happening in China is yet another medium-term uncertainty. So at some point, we're going to have to pivot. But investors right now are just happy focusing on the short term, and the short term has rewarded them in virtually every asset class.
Are you unveiling a new iPad later or something like that?
I was just going to ask.
Or were you watching Andrew Ross Sorkin get some new fashion out there earlier this week as well?
This is my commitment, okay, to Squawk Box. I am in Michigan. I didn't bring a shirt or a tie, but when asked, can you help us out, I said, sure. I'll come. Okay, so this is it. This is how you see me when As long as you don't see my jeans and my shoes, I'm fine, okay?
I was just making sure. I like the look that you're rocking today. Seriously, though, the biggest risk to investors right now is what, do you think?
Well, there's a few. One is global growth is not picking up despite optimism. Two, it's not clear that we have stopped deglobalizing. Three, central banks are becoming less effective. And four, we've overpromised liquidity to the end investor. So there are lots of risks out there. I think the major question is, while riding this wave of liquidity, do you go up in quality to become more defensive for the medium term, or do you come down in quality to try and get more returns in the short term? I prefer the former. I think that you should be increasingly more defensively oriented while keeping a claim on the upside. But most people are doing the latter. And that's why I think that later in the year, we may have a lot more financial stability.
Mohamed, to the global growth point and the central bank point, what did you make of Lagarde's first press conference?
So I think it shows she's a great communicator. She gave us a little bit on the strategy review, but not very much. I thought it was interesting that she was upset with this notion that the central bank policy is predestined. They're trying to get us away from being conditioned to expect central banks to always provide liquidity, but they're not succeeding. And she is trying, like Chairman Powell did when he first came in, to tell the markets, hey, you can't rely on central banks all the time. The trouble is that message isn't getting through, and Lagarde is going to face the same outcome as Powell in terms of markets just continuing to press central banks for more liquidity.
I would be skeptical of her saying that, right? When she's still someone who is very, very upset with the United States for ever having let Lehman fail. I mean, I consider her very dovish. I don't know that I would believe her either.
Yeah, and this notion in central banks that you need insurance stimulus, meaning it's not going to have an immediate impact, but you might as well insure for the future, is very deeply embedded. And after the scare of the fourth quarter of 2018, it's going to be very difficult for central banks to step back. So, we're going to continue this, but at some point, fundamentals matter. At some point, liquidity becomes counterproductive. Look at negative interest rate. And at some point, investors become less risk-loving. It's very difficult to call that point.
Mohamed, it's Joe. We keep talking about liquidity. Liquidity seems to be finding a risk appetite for growth. Are you concerned with that strategy maybe being a little bit too euphoric?
Yeah, look, I think it's really important to look at different asset classes. We tend to focus on stocks. But what's the 10-year doing at 174 when stocks are doing what they're doing? What's the 210s doing at 21 basis points? And I think what that tells you is liquidity has lifted all boats. And we have to understand that this is not a fundamentally driven rally. This is much more liquidity-driven rally. But you know what? You continue doing what has worked well, and it has been wonderful for investors. So I understand I myself continue to ride this liquidity wave, but I'm doing it increasingly in a more defensive manner.
Where are you on US GDP for the year ahead, not just for economic reasons, but for the election? Do you think picks up a little bit of extra steam now we've got the phase one deal and holds pretty strong through to the election?
Yeah, I think we're looking at probably a 2 to 2.5%. I don't worry about the U.S. economy when I look at the global economy, but I really worry about Europe. Europe is very near stall speed. That's about 1% growth. And when you get to stall speed, the risk of recession goes up. So if you want to look at weaknesses, look at Europe, and then look at the mounting challenges to Chinese growth. They are managing a very tricky medium-term transition, the middle-income transition. That is where the risks are in the global economy. It's not in the U.S.
And Mohamed, if I told you, through earnings season thus far, earnings growth is negative, yet we're going to open this morning with another record high for stocks. What do you say to that? How do you reconcile that?
I will tell you more of the same. That's what we have seen previously. We saw it happen last year. And I can point to so many market anomalies, correlations that have broken down, volatility that refuses to step up. I mean, everything has broken down because the liquidity inflow has been so strong that it overwhelms everything else. And it overwhelms earnings as well. So, these are all indication that we are living in this wonderful world of liquidity, but be careful. There is an end at some stage. It's just very difficult to say when.
What do you think of gold, Mohamed?
So I think that there is merit in looking at gold as a hedge. There are very few hedges left out there, very, very few, unless you can tail hedge, but that's quite a sophisticated strategies. So, gold belongs in a portfolio. I would just, not go overboard on it. I think there's two major challenges, and I think investors have to take seriously. One, reconciling short-term favorable momentum with mounting medium-term uncertainties. And second, finding some risk mitigation out there that they can have in their portfolio that is still valued attractively. There are very few risk mitigating strategies that are valued attractively right now for the retail investor. And that's an issue for the long term.
You think the market is too complacent about this virus? You look back at what happened with Ebola, the S&P went down 10% in not that far of a period. And people are saying now that stocks are ripe for a pullback. They just need a catalyst. Do you think this could be it or no?
Only if it really spreads. The markets have understood that when you have low probability, high impact events, and this is a low probability, high impact. Low probability in the sense that it's not likely to spread worldwide. High impact that if it does, then we have a major issue. The market has understood that when you have that sort of mix, it's better to fade it immediately. And that's exactly what we've done this way. It doesn't mean there's no impact. This could knock up to 1% growth of China. That's meaningful. It's going to have a huge impact for those who supply travel services and internal trade services to China. So it will have focused effects, but I understand why the market's reaction is to shrug it off and say it's contained, it's isolated, it's not a macro theme.